Hello learners, welcome again to Manifested e-learning platform. Today I would like us to finalize the tax planning topic with the areas that remained. So we covered some areas like evaluation of job offers, and today I'd like us to look at the remaining subtopics. So the major topics still we are at tax planning, and there are some subtopics that remained which I would like us now to finalize. The subtopic number 1 is tax avoidance. And avoidance provisions or measures. The other subtopic that remained is uses of tax incentives. The other one was disposal of a business operation and restructuring activities. We also had says a special economic zones, Special Economic Zones Act, and the last one we had tax risks. So let's start with the first part, that is tax avoidance and avoidance measures. Tax avoidance and anti-avoidance measures. And when we talk about tax avoidance, what do we really mean? Tax avoidance is a legal way of reducing the tax burden. It's a professional way of minimizing the tax burden. That is, reducing the tax burden without violating tax rules and regulations. And therefore, if the taxpayer engages in tax avoidance, he cannot be penalized by KRA because that one is a legal practice. Tax avoidance techniques includes, for instance, taking advantage of capital allowances. When you are calculating, for instance, the taxable profit, you can calculate capital allowances, you treat it as an allowable deduction, therefore you end up reducing the taxable profit and tax liability. Again, still, for instance, somebody may want to finance his business, maybe as a manager. So you can finance your business either through equity or through debt capital. So a manager can opt to finance his business through debt capital because he will be required to pay interest, and that interest is allowable when calculating the taxable profit, therefore paying again less tax. Another example is manufacturers. As a manufacturer, one can manufacture goods for export or for local consumption. If one manufactures goods for export, then exports are zero rated. So VAT is charged at 0%. These are for exporters. But if you are producing goods for local consumption, then you are charged VAT at a standard rate of 16%. So again, somebody can do avoidance by manufacturing goods for export so that one may not be paying VAT. But for local, you will be required to pay VAT at a standard rate of 16%. Then again, we have anti-avoidance measures. And avoidance measures means a situation whereby somebody can engage in tax avoidance technique, but the commissioner say to such transactions. This is covered under Section 23 of the Income Tax Act, and it states that not all transactions are acceptable as tax avoidance techniques. There are two major cases that we can discuss here, which the commissioner can reject such particular transactions. For instance, if we have like a director in a given company who buys a car from that particular company at a throwaway price, and that car was bought, it was captured in a given class, maybe for the purpose of calculating the capital allowances. It was included there. Then the director opted to buy it at a throwaway price. So if it is bought at a throwaway price, we subtract that value when calculating the capital allowances. And as you remember, the way we calculate capital allowances, we have classes like class 1, class 2, class 3, all the way up to class 4. So if it is like motor vehicle, it was bought and it captured like maybe a lorry in class 1. Maybe it was bought for like a price of like 20 million. Then after 1 year, the director buy that particular asset at a price of like 1 million. And therefore would like you to see, for the purpose of calculating the capital allowance, we less the selling price. And therefore what will be subtracted is 1 million. We included 20 million, we less now 1 million. And therefore, because this car now is disposed, we will leave figures in the computation of capital allowances like 19 million. We continue to claim for capital allowances, but this asset is not existing. And therefore, that now make the commissioner to reject such a given transaction. Another example is like if maybe we can have a child who is employed like in a company, and this particular child, maybe the company is owned by the parents, but the child is getting very, very high salary. And as you know, it is not possible for the commissioner to enter into a contract with a minor of paying tax. And therefore, if we have a scenario whereby this child is getting very high income, but she's not paying tax, the commissioner will reject such a transaction. And therefore, such a salary, the commissioner will not allow such an expense which is salary to be treated as an allowable expense. The commissioner will either say that salary be treated as disallowable or that income be taxed on the parents. So that is how, those are some of the cases whereby the commissioner can reject some of the tax avoidance practices. And again, in case of the director buying a car, so the direction that the commissioner take is, the commissioner will come up with a view that what is subtracted here as the disposal value when calculating the capital price, the capital allowances, what is supposed to be deducted is the market value of that particular lorry, but not the selling price like we normally do when we are calculating the capital allowances. So maybe after 1 year, like this particular lorry that we captured in class 1 is likely to have a value of like 18 million. And therefore, when we less that, we will not be claiming capital allowances and the asset is not existing. So that is what maybe we need to understand under tax avoidance and tax avoidance measures. Number 2, we have tax incentives. Tax incentives. We have uses of tax incentives, but first of all, it's good we know what are tax incentives. A tax incentive is an incentive that is granted by the government or KRA to persons or to taxpayers in order to encourage them to continue to pay tax or to attract new taxpayers to the tax system. Remember, we cannot survive with the current revenue that we are generating. The government needs to keep on generating more revenue. And as you know, the government expenditures tend to increase day and again, and therefore we need to come up with a way of increasing this particular revenue. And one technique is by introducing tax incentives. When we give these incentives, we tend to attract people and or to motivate those people who are paying, and therefore the government is able to raise more and more revenue.